Hi, welcome once again. So we're proceeding with the issue of the fraud risk management. So we're picking up from where we left. So at this point, we'll be considering fraud schemes that under state liabilities. Like I said, we will be looking at liabilities and then assets, and we may not go into revenues and expenses for now. We'll just hang on to this because those are the difficult areas to identify. What we should know is that sometimes, not even sometimes, mostly it is difficult to identify fraud risks that are enshrined within liabilities. They are the most difficult areas where you could hardly be able to detect these elements. So let's look at some of these fraudulent schemes that under state liability. So usually you will see management trying to manipulate earnings. So what they do is that they will fraudulently increase reserves in their balance sheets or in their statement of financial positions in one period, and then in subsequent periods they will be releasing it. As usual, what they will do is that they will then, you remember reserves, the reserves will have these credit balances. So they will overprice it, they will increase it, whatever reserve it is, they will increase it. And then in subsequent periods, they will then debit the reserves and credit the other leg in income, increasing income, so that they could report some fraudulent earnings when in reality it's not. They could report it as other income, other comprehensive income, whatever names they would try to use it. Okay. So that's what they do so that they could just deceive the masses or the shareholders that yes, they are meeting expectations, they are increasing revenue. So the easiest way to identify the understatement of these liability fraud exposures is to identify these various transactions that involve liabilities and can be understated. Okay. Now we'll be analyzing accounts that involve these, and typically we could look at least six different ways in which liabilities can be understated. Again, besides the overaccruing of reserves, they could also understate liabilities. That's what we are saying here. Because once you understate liabilities or even expenses, what you are doing is that you are increasing income. Okay, because liabilities will have effect on our income, on our returns, on our because even if you are owing creditors, at the end of the day you pay them. Okay, once you pay them, you know that the other leg will reflect in expenses. So what happens is that they will try to conceal these things so that you don't find it. We'll look at more examples so you will better understand. So these are six major liability fraud schemes. One, purchasing inventory. Okay, the accounts which could be affected are the inventory account or the stock account, and then accounts payable. What are the fraud schemes they will normally um, use? They could record payables in the subsequent period, not in that same period, so that they could cut down on that picture that they are owing people. Okay, that they could also not report purchases. If you don't report purchases, what happens to cost of goods sold? What happens to your sales? It the net sales, or what happens to your gross profit? It pops up. Okay, so they will understate or they will not record purchases at all, or they could overstate purchases returns and purchase discounts, so that at the end of the day they get a good picture in terms of gross margin. Okay, they could also record payments made in later periods as being made in earlier periods. Okay, payments which have been made in later, they could report it as being made. And then fraudulent recording of payments, for example, kiting. Okay, they could also incur, the second one, transaction could incur payroll and other accrued liabilities. But what accounts will be affected as usual? Payroll, tax expense, salary expense, various expenses, salaries payable, payroll taxes payable, and then other various accrued liabilities. What they could do here is that they will not record the accrued liabilities. Okay, and they will also not record accruals in the later periods. They could also sell products, so accounts which will be affected as usual are sales accounts, unearned revenue, and then accounts receivable. And what will happen here is that they could record unearned revenues as revenues earned. Okay, so because, for example, you're going to produce something for a customer and it's not ready yet. Ideally, the person gives you the money you should know that you are more or less owing this person because you've not provided for this person. So they should be recorded as deferred income or unearned revenue, let me put it that way. In which case, you will have to keep it as a liability on your balance sheet so that once you have produced a supply to the customer, you can then reverse the transaction by debiting that unearned income, and then you credit the revenue. But what they will do is that they will record the revenue as if it has been earned now, so that they could inflate their gross margins or gross profits. We could also sell services, repay deposits, or repurchase something in the future. Future commitments, okay? So accounts involved could be warranty, service expense, or warranty or service liability. And here they may not record as usual the service liabilities, or they will under record it, or they will record deposits as revenue. Okay, it's interesting. And or they could also record repurchase agreements. They will not record repurchase agreements and these commitments at all. They could also borrow cash, and these accounts which are involved, what they will do is that they will borrow from related parties at less than an arm's length transaction. They will not record these liabilities. They will borrow against equities in assets, and they will write off liabilities as if these liabilities have been forgiven, when in reality they still owe these liabilities. And they could also claim personal liabilities as personal debt, liabilities as personal debt rather than as debt of the entity. And it happens a lot, especially in financial institutions. They could also incur contingent liabilities, and what they will do is that they will not record these contingent liabilities at all, or they will under record it at a very low amount. Okay. Now the reason why they do this, if you are a lender and you want to help someone, or you want to these companies come to you and you see on their books that they have higher liabilities, what would you do? You either give it to them at a higher cost of lending, or you will not give it to them at all. So they'll try to play with it. So it has two legs: to deceive the investing public or the lenders, or to deceive shareholders um, by running that other leg, so that they will get a better outlook on their financial statements. Okay. So we've looked at this. All that we've said in that table is what I've populated here. They will understate accounts payable by not recording it, or recording the purchases after the end of the year. They will make it appear it is something which occurred after the cut-off period. Okay, they could overstate purchase discount. Which, look at this, I've said this, they could write off this debt as if they've been forgiven, when in reality they've not. They could also understate accrued liabilities. Okay, they could understate accrued liabilities. We look at this in the table. So the same thing we look at in the table is what we are finding here. Recognizing unearned liability, revenue, as if they have already earned it. And the recording future obligations, future commitment, the warranties, the contingent liabilities, they will under record it. Okay. They will also not record various debts, mortgages. They don't want it to appear on their books. They will claim it as if it's a personal debt, when it is actually the debt of the organization, and they will meet contingent liabilities. Now, in discussing how liability related frauds can be detected, we need to focus on two things: the accounting or documentary evidence, and then the analytical symptoms. So we'll be looking at more of analytical symptoms. Okay. Why are we doing this? Because they are some of the most effective methods to detect fraud. So take the financial statement, look at the accounting documentary evidence, including the non-financial disclosures. Okay. And then try to conduct some analysis and see if you could get some analytical symptoms popping up. Okay. So for analytical symptoms, accounts payable, we still look at these 6 items. Okay. Accounts payable, if the balances appear too low, question it. If purchase or cost of goods sold are too low, question it. They may be trying to play something tricky just to overstate income or revenue or gross profit. Purchase returns or discounts on purchases are too high, question it. Okay. When unearned liability balances appear to be too low, but revenue accounts appear to be too high, question it. They may be throwing some unearned revenue into revenue. When balances in warranties, repurchase, or deposits are too low, question it. Okay. they may be understating it. When um, um, we are looking at mortgages, okay, or unrecorded term loans, okay, when you see an unreasonable relationship between interest expense and the recorded liabilities, they are not really matching, they are not jiving. Question it. Significant purchase of assets with no recorded debt. Did they really buy the asset with cash? Can we find evidence? Okay. And it doesn't make sense for you to go and buy this whole asset with cash when you can go for a finance lease. Okay. Significant decrease in recorded debt. The debt has been recorded. The debt has been slashed. Ask yourself, have they been forgiven that debt? What is the documentary evidence? Okay. And then also look at any notes payable mortgages which are very low, pension liabilities which are very low. In effect, look at for any suspicious items in terms of liabilities and expenses which have been understated. Okay. Also, with the documentary evidence, we should look at all kinds of understatements of liability fraud and by looking at, do they have the originals of the purchases or they are just giving you photocopies? Question photocopies. Look for the originals. Okay. Can you see any unusual discrepancies between the company's records and confirmation replies from suppliers or even from customers? Okay, if you are looking at revenue, but look at this. Also, transactions which are not complete. Okay, transactions not recorded in a complete and timely manner should be questioned. Balances or transactions that lack supporting documentations. Meanwhile, you realize that there could be some adjustments which have been effected, but you are not getting the sufficient documentation to support these adjustments which have been passed. And also, when you get questions or stories about documents are missing, reconciling items cannot be explained, question it, okay? And if you're also denied access to some records or facilities, you are denied access to speak to some employees or customers or vendors or others who could give you some evidence, you should know that there could be some question marks somewhere. Now, two areas we should also look at for in terms of accounting documentary evidence. Be proactive and search for analytical symptoms. As is something too high? Is something too low comparatively? Are the numbers the same from last year to this year? Why should the accounts receivable from last year be the same as this year? Why should accounts payable should be the same as last year compared to this year? Okay. So you could unravel this fraudulent activity. So analyze these financial balances and try to look at the relationship within the financial statements year on year. Okay. So look out for any changes in the balances. Perform some trend analysis, some horizontal, vertical changes, and try and see. Focus on the changes in the actual numbers, not the percentages. Okay. Study the statement of cash flow. Use horizontal analysis, like I said. Use vertical analysis. Compute ratios. I'll show you again in the appendices. Ratios which you could use to detect some of these. They are the normal ratios, very easy to compute, okay? And then also, you could also compare financial statement amount or relationships with other information, non-financial. So if there's any contingent liability which has been stated in the disclosure requirement, if they are saying they use some money for sustainability activities which have been claimed as tax allowable expense, try and see if you can you can match whatever is in the financials to the non-financials, okay? Also, we should also consider focusing on changes in recorded balances from period to period. Like I said, is the number being the same? Do we get a 0% change or a significant jump year on year? Check whether the changes make sense. Okay. Also consider the relationship from period to period. Use vertical analysis. Do some cast checking to see whether the numbers are working. Again, like I said, um, if you go to Appendix 2, Appendix 1 has those long 21 questions, critical questions to ask. Appendix 2 looks at these um, ratios which you could use to detect for horizontal analysis or for vertical analysis, ratios you could use to detect these liability frauds. Okay. Again, compare financial results and trends of the company with those firms who are operating in the same industry. So is Amazon and then EB, for example, compare and see whether they are all it makes sense. Okay. Also compare recorded amounts in the financial statement with non-financial, like I've said. Try to jive them where possible to be sure that the figures match with the qualitative, with the narratives. Okay. Also, well, there could be some exceptions. For example, mortgage liabilities, which are loans, are secured with specific assets. So, if they are secured with specific assets, try and see if the company or the lender has a lien over these assets. Okay, so try and match these items. Documentary symptoms can be very helpful in detecting understatement. So, any specific documentary symptom you search for could vary based on the asset or the liability you are looking out for. Okay. Again, in Appendix 3, I've summarized some of the most common kinds of documentary evidence by type of liability. You could take a look at that. Okay. Now, assets could also be overstated. That's the reverse. Okay. That's the reverse. They will understate liabilities so that the net effect in terms of expenses or the outlook for investors who want to invest will look beautiful. They could also overstate assets. They can also overstate revenue, but we're not going into revenue. Okay, so overstatement of assets can occur in many ways. Most physical assets are valued at historical cost, less accumulated depreciation, we know, right? But assets could be improperly depreciated or amortized. They could decide to use a very low depreciation rate just to make sure the asset has a bigger value on their books. In addition, expenditures may be improperly capitalized as assets. They could improperly capitalize some research and development costs as assets. And most organizations could have several types of these assets appearing on their balance sheet, but in reality, you may not be able to get the liability that corresponds to them if only these assets are bought on credit. Okay, so we should look out for these 5 most common assets that are overstated are provided in this picture. So you see overstatement of cash or short-term investment in marketable securities, overstatement of inventories and then receivables, overstatement of non-current assets, overstatement of assets through M&As or by manipulation of intercompany accounts, related party transactions, okay, and also overstatement of intangible or deferred assets. They could also even capitalize intangible assets which are developed in-house. You remember your IFRS, IAS 38 intangible. So it is also one thing you should look out for. So like I said, they could improperly capitalize costs as assets which should have been expensed. Okay, R&D, I mentioned R&D. So startup costs like advertising costs, research and development, marketing costs, salaries, and other initial costs. They'll capitalize it when they should have expensed it. Okay, so it's interesting why they do that, because accounting somehow gives them that chance to do that. Expenses and assets all have debit balances. So who will see it? Okay, who will see it? So management will often argue that the company is in a startup mode, developing phase, so they would think that these needs to be capitalized and they will be written off later against profitable future operation. But it's criminal. It's criminal. They could also overstate. They could also overstate account receivable. These are not related to revenue recognition, okay, or inventory, which are not related to cost of goods sold, in order to overstate reported income, get a good profit. Okay. Again, there's one interesting thing we should look at, which is the slippery slope of earnings management. Management will normally do this. Why? Because they want to report some good earnings for them to get some bonuses at the end of the period. Okay, so they could improperly apply the gaps, the IFRS and then the IAS to their advantage by trying to use some questionable accounting practices. Okay, they could also overstate, inflate mergers, assets which are acquired through M&As. So I put all of this in that picture we saw. Okay, so they could improperly or inappropriately record market values for assets. They will have the wrong entity to act as a purchaser of the other entity, or they couldn't properly allocate book values to the asset during the periods of acquisition or restructuring or reorganization. Cash and short-term investment, like I said, they could inflate it. They could falsify audit confirmations or bank confirmations. They could even work with some of these banks to give them some falsified bank confirmation documentations. Okay. And employees or vendors stealing significant amounts of cash said that it results in misstated financial statements could also be one key item. Another way assets and liabilities can be manipulated is to keep them off the balance sheet or transfer troubled assets off the balance sheet into another company so that you don't see it at all. Because if you see any questionable transaction, liability, or asset, that is where you raise a question. But if they keep it off, what are you going to ask? Where will you even find it to ask unless you go deep and, and detailed enough? Okay. They could also overstate fixed assets, like I said. And there's several ways where they could do this by leaving worthless or expired scrap values on the books. Instead of writing them off, they will leave it there. They could under report depreciation or use lower rates. They could record fixed assets at inflated values, and they could also fabricate fixed assets to record, or they couldn't recognize intangibles which they are not supposed to recognize. So Appendix 4, again, will provide a summaries of frauds involving the understatement of assets. Now again, let's search for symptoms. Inappropriately capitalizing cost, that should be expensed. Look out for questions. So what are the symptoms you would always look out for? In many companies, they do not have to capitalize this. Okay, like R&D research, you don't have to capitalize it. So this more skeptical approach is often justified because these assets are often intangible and can easily be abused. So be critical enough to question any expense, any costs which have been um, capitalized when they should have been expensed. In terms of M&A acquisitions, as with any improper capitalization, understanding the general context of the merger or the intercompany relationships, okay, should be taken important when determining whether frauds exist than trying to identify some specific analytical symptoms. You can't get that one. Okay, so you have to always question who is acquiring the company. Why? What is the background of the company? Why is it paying such a price? Okay, trying to find, is it any intercompany relationships? Does any of the management members have a hand in the selection or in the determination of who buys or merges with us? In terms of the short-term cash and cash equivalents, we should also look out for symptoms. Verify the records, the recorded amount of cash by getting some more independent and justifiable confirmation from the financial institutions. And also, if the amount of cash the company has is small, you should look at it. It may raise questions. Maybe they've taken it off the balance sheet. Okay. Again, what about overstatement of the receivables and inventory? Always, almost always, when accounts receivables are overstated, it means revenue is also affected. We've also overstated revenue. Okay. Remember, revenue works mostly on accrual basis. So what will happen is that when inventory is overstated, cost of goods sold will be understated. Then we'll be reporting higher profits. Okay. So we should be careful when this is happening. We need to look at the corresponding, look at the revenue. Is it jiving? The same as what has been overstated in receivables. Okay. Now, there should be one more thing we should look at for inadequate disclosure frauds occur. So we may not be able to disclose everything. Financial statement normally should be line items on the face. And we should also have disclosures, narratives, supporting footnotes. But inadequate disclosure frauds occur. They normally occur. So where we mislead the stakeholders or the users of the financial statement by not properly disclosing everything. So this occurs in the company's annual releases, annual reports, where they do not provide everything. Even in the footnotes or even in the financial statement, they do not provide everything. So disclosure fraud can also make the statement look questionable. You may not even rely on it, misleading, or by commission or by omission or fraud. That could also cause the whole financial statement to look questionable. Okay, different kinds of disclosure fraud. Okay, what are they? So we could have misrepresentation about the nature of the company or its product, usually made through news reports, interviews. You see this person is always in the news trying to advertise, talk about his product. Why is this guy always in the news trying to project the image of the company? I'm not saying you shouldn't market your organization, but there could be some misrepresentation. There could also be some omissions or misrepresentations in the integrated or sustainability report or the CSR reports. So be careful what reports they supply, because normally these CSR reports or sustainability reports are produced in order to court public favor. So they will try to put in something just to appease the public, but it may not be true. If possible, verify what they have stated in their report, whether it can be found on the field. Okay. There could also be misrepresentations or omissions in the footnotes, or they could fail to disclose some related party transactions appropriately. Now, detecting inadequate disclosure is usually easier to detect inadequate disclosure fraud that involves misleading disclosures than it is to detect to detect disclosure fraud that involves missing disclosures. Okay, so if it's misleading, we can always detect. We can match it to what the reality is on the ground. But if it is missing, it's difficult to detect. So mostly, what they will do is that when they realize this disclosure will pose problems, they knock it off from the books. Now, symptoms you should look out for in terms of this inadequate disclosure. With overall representation of a company, it is necessary to look out for symptoms related to the nature of the company, the industry in which it operates, or the environment in which it operates, its assets, the organization, okay, and then the management and operating characteristics, the profile. Is it a new company? What happened? Does it have a very short history? Okay. Also, you should also look out for different kinds of symptoms in terms of non-financial components or disclosures. Not only the numbers, okay, the non-financials are also very important. People also look at that. Take a broad view. Look at the kinds of symptoms you can think of. Um, Anything that comes into mind in fraud examination or fraud risk management, make sure that you have an open mind, and there should be the very high level of professional skepticism. You also need to look out for companies that have unrealistically large growth in assets, large revenues, large profits in a short while. This guy is making like 3 times the profit somebody who has been in the system for like 10 years is already making. And when they are providing their history or their reports, you see something very short. They will not involve anyone. In fact, the management who are being disclosed, people don't even know about them. They don't know about their backgrounds, and anything you report looks suspicious. You got to be careful. Again, we should also look at disclosure frauds and footnotes and financial reports. Okay, so several frauds, again, still on the footnotes and the financial reports. Several frauds assessment techniques can be used to detect this. Look for inconsistencies, match them, reconcile the figures to the numbers, make inquiries of management, do some background checks, look out for any related party relationships. Okay, contingent liabilities, any contractual obligations, review their files, obtain their files from the Securities and Exchange Commission, from the stock market if they are listed, from any regulatory body, from the FCA, from the company's house, and check whether the names of the officers they are reporting about are credible. They know them, whether these regulators recognize them. Okay, there could be other types of financial statement fraud. Like I said, besides the revenue, we didn't look at that. There could be expenses, okay? Others could also be non-monetary transactions, round trip transactions, improper accounting for foreign payments. And then we can also look at improper use of the GAPs or IFRS or ISIS, okay? and also improper use of off-balance sheet arrangements are all part. So these are the appendices. These are the 20 the critical questions you should ask when you are doing financial statement analysis and trying to understand them. So this could help you in real life, in real practice. Okay. So 23 questions actually. I said 21. There are 23 questions. Okay. Again, these appendix two ratios you could use in detecting fraud. And you know some of these ratios, okay? Asset test, current ratio, and this, all of these are provided. And again, so that's fine. And then appendix three looks at documentary symptoms of fraud, which we could look at for in terms of liability understatement, okay? Understatement. And then frauds involving understatement of assets, liability, okay? And then we're talking of also asset understatement. So look at the accounts which are involved and what they could do. And then finally, I'm giving you Appendix 5. The UK anti-fraud organizations, these are organizations responsible for fraud prevention or detection in UK. So there's SFO, the NCA, Crown Prosecution Office, Action Fraud. We have CFS, we have Fraud Advisory Panel, and we have the UK Finance Economic Crime Team, and then the NHS Counter Fraud Authority. Yes, that is it. Perfect. And again, there's one more thing we could have also considered, which has to do with the professions or the careers you could pursue in terms of fraud risk management. It could be an auditor, okay. But if you want to really be considered a fraud certified fraud examiner, it's not about writing an ACCA or CIMA or ICAS. You don't become a fraud examiner by virtue of taking these exams. You need to undertake the Association of Certified Fraud Exams based in Austin, Texas, and they are accredited to issue you with that license to operate or to to practice as a fraud examiner. Okay, so that is it. And then the next thing will be our workshop or tutorial questions in class. Thank you and see you soon.